question 13 is dealing with the accounting for an investment which moves from a 25% shareholding purchased a number of years ago to an overall 55% shareholding during this year as the result of an additional purchase of 30% on the 1st of June 2000 X4. So the question asks us which two of the following statements are correct in respect of the year to 31st of December 20X4. So the first is that LD will continue to exercise significant influence over FW despite the fact that additional shares have been purchased. The second is that they will calculate goodwill on the acquisition of FW at 1st of June X4 as they now exercise control. The third is that the 25% existing holding in FW is included in a goodwill calculation at original cost. The fourth is that any NCI in FW will be recognised and included in the equity section of a consolidated SFP. And the final option is that the investment in FW will be equity accounted in the consolidated statement of profit or loss throughout the year to December X4. So if we just think about this one in a bit more detail then, the original holding was 25%, and at 25% all we have is significant influence. Where we exercise significant influence, that means in actual fact that investment is accounted for as an associate, which means we are adopting equity accounting. Once we purchase this additional 30% on the 1st of June, we now have a 55% holding, and at 55% we have control. Once a control relationship has been established, we should be accounting for the investment as a subsidiary in the consolidated statements. So just looking back to our statements then, the first can't be true because once we have 55%, we actually have control much more than we have significant influence. So note that's an incorrect statement. Once we think about accounting for our investment as a subsidiary, that does indeed mean that we would need to calculate goodwill arising at the date of acquisition. So the second statement appears to be correct. As part of that goodwill calculation, we will need to think about how much we've actually incurred as a cost on our investment. But as the acquisition has been piecemeal here, instead of going back and using original cost for the 25% originally purchased, we would instead include that 25% at its fair value at 1st of June. So the other statement here which is correct is number 4, which says that the non-controlling interest will be recognised and included in the equity section. On any consolidation, we will have to include something for non-controlling interest to represent the shares held by others, and yes, that does form a part of the equity section.